You know what really keeps most traders awake at night? It's not the fear of a bad trade. It's not even the sting of a heavy loss. Those hurt, sure, but they're clean pain. You can point to the chart, the entry, the mistake, and say, that's where it went wrong. No. What eats at traders is something much darker. Something that doesn't hit you once. It keeps returning. Quiet, persistent, like a slow leak in your confidence. It's inconsistency. One week you feel unstoppable. You're reading the tape like it's written in your first language. You're calm, sharp. You're early to moves. You exit with precision. You size correctly. You hold winners longer than your fear wants you to. And then the next week, you might as well be throwing darts blindfolded. You make money on Monday. Give it back by Wednesday. By Friday, you're staring at the screen, wondering if you ever understood this game at all. And that kind of confusion, where your results feel random even to you, is more terrifying than any single loss. I've been there more times than I care to admit. Certainly more than the newspapers ever wrote about. They loved printing stories about the millions, about the legendary trades, about the times I broke the bears or rode the bulls into fortune. But they didn't write much about the nights I spent alone in my study, silent, exhausted, staring at my trading journal, trying to understand why I could read the market perfectly for months, and then suddenly go stone blind. That inconsistency nearly destroyed me more than once. And let me tell you something important. It wasn't the losses that hurt the most. It was not knowing why I lost. It was that helpless feeling, like you're at the mercy of something you can't control, can't predict, can't master. Like the market is flipping a coin and deciding whether you eat or starve. Here's the part nobody wants to hear, but every trader needs to accept. The market doesn't care about your winning streak. It doesn't care that you just made $50,000 in a single afternoon. It doesn't care that you've been right 7 times in a row. It doesn't reward you for effort. It doesn't punish you out of spite. The market is not your friend, and it's certainly not your enemy. It simply is. It moves according to its own laws, its own rhythms. Rhythms that don't adjust to your confidence or your fear. And if you're going to survive in this game, you need to understand something that can change everything. Your consistency problem isn't really about the market at all. It's about you. I learned this the hard way, and I learned it multiple times because I'm stubborn, and because the most uncomfortable truths are the ones we resist even when they were staring us right in the face. The first time I really made money, I was convinced I had figured it out. I was young, cocky. I had turned a few $100s into thousands through sheer nerve and what I believed was brilliant analysis. I walked around with that dangerous feeling traders get when the market rewards them early. The belief that you're different. Then I lost it all, every penny, and then some. I was wiped out so completely that I had to borrow money just for train fare. That should have taught me something permanent, but it didn't, not really, because I made it back, and then I lost it again, and then I made it back again, and then I lost it again. That cycle repeated itself throughout my early years. And every time I told myself the same lie. This time is different. This time I learned my lesson. But here's what I eventually discovered. This is the key to everything I'm about to tell you. The consistency problem exists because we are not consistent beings. We're emotional creatures playing an emotional game in an arena where emotions are the enemy of profit. Every trade you place is influenced by your state of mind in that moment. Your confidence level, your fear level, whether you slept well, whether you're fighting with your spouse, whether you're trading scared money or house money, whether you just had a big win or a humiliating loss, whether you feel like you're on a roll, or you're desperate to make it back. All of it bleeds into your decision-making, usually without you realizing it. Meanwhile, the market remains utterly indifferent. It doesn't care if you're confident or terrified, well-rested or exhausted, calm or desperate. It moves based on the collective actions of millions of participants, each with their own emotions and agendas, creating patterns that are sometimes readable, and sometimes completely opaque. And here's the cruel joke. The very traits that make you successful on your best days, boldness, decisiveness, confidence, are the same traits that can destroy you on your worst days when they turn into recklessness, impulsiveness, and stubborn refusal to admit you're wrong. I spent years trying to eliminate emotion from trading. I thought if I could just become mechanical, systematic, emotionless, I'd finally become consistent. So I built rules, ironclad rules, rules I swore I would never break. And you know what happened? I broke them. Not every time, but often enough that they might as well have not existed. I broke them when I was angry after a loss and wanted revenge on the market. I broke them when I was overconfident after a winning streak and believed I could see what others couldn't. I broke them when I was scared and convinced the old patterns wouldn't hold this time. Then came the turning point. After one of my most spectacular failures, I finally saw the truth clearly. I had built a fortune, real money, through patient, disciplined trading. I had followed my system. I waited for proper setups. I managed size carefully, cut losses fast, let winners run. Everything was textbook. And then something shifted inside me. Maybe it was complacency. Maybe it was the illusion that success creates. The feeling that you've earned the right to bend the rules, but I started taking small liberties with discipline. Just small ones at first. A position slightly too large, a loss held slightly too long, a trade taken without my usual signal, just a hunch. And here's what made it dangerous. Some of those violations worked. A few paid off nicely, which reinforced the most poisonous belief in trading. Maybe I'm beyond the rules now. Maybe my intuition is enough. That subtle shift from discipline to arrogance didn't cost me everything in one dramatic moment. It cost me slowly, quietly, through a death by 1,000 cuts. And when I finally sat down and analyzed it honestly, I realized something that changed my entire approach. My inconsistency wasn't random. It had a pattern, a psychological pattern. I was most disciplined when I was scared, when I was rebuilding, when I had something to prove, when I knew one mistake could ruin me. And I was least disciplined when I was comfortable, when success came easily, when I felt like I had mastered the game. In other words, my worst enemy wasn't the market. It was success. Winning made me sloppy. Winning made me overconfident. Winning made me forget that the market can humble anyone, at any time. That realization was devastating and liberating. Devastating because it meant my consistency problem couldn't be solved by finding a better indicator or learning another strategy. Those things matter, but they're not the core issue. The real solution required something harder. I had to become consistent as a person, not just as a TR. Ader. Because trading doesn't just test your intelligence, it tests your character. Most people can ride emotional waves in everyday life without immediate consequences. In trading, every emotional indulgence shows up on your account statement. The feedback is instant, brutal, measurable. So how do you solve the consistency problem? How do you transform from someone who trades brilliantly one day and terribly the next, into someone who can execute at a high level regardless of mood, regardless of streaks, regardless of market noise? I'll tell you what worked for me, though I warn you, you probably won't like it. It's not a secret indicator, not a magical pattern, not a perfect time frame. It's brutal in its simplicity and painful in execution. You build a system, and then you follow it with religious devotion, especially when everything inside you is screaming to do something else. You follow it when you're winning, and you feel invincible. You follow it when you're losing, and you think it's broken. You follow it when you see what looks like the opportunity of a lifetime, but it doesn't meet your criteria. You follow it when you're scared, greedy, bored, excited. You follow it until following it becomes more natural than breathing. But here's another truth. The system itself almost doesn't matter. I've seen traders make money with dozens of approaches, trend followers, mean reversion traders, fundamental analysts, pure tape readers. The methodology is less important than the consistency of application. What matters is, 1. You have a clearly defined approach that gives you an edge, even a small one. 2. You execute that approach the same way, every single time. A small edge, applied consistently, compounds into something enormous. Let me give you a practical example. One of my core principles was simple. I only traded stocks that were already in motion, showing clear directional movement. I didn't want to predict the turn. I wanted to see the turn begin, then ride momentum. Sounds easy, right? But implementing it consistently is torture, Because the most tempting trades are always the ones where you think you see the turn before it happens. You see a beaten-down stock and convince yourself you've spotted accumulation. Your ego wants you to be the genius who called the bottom. Your system says, wait for confirmation. And yes, waiting will sometimes cost you a move. You'll watch it rally and feel foolish. But over thousands of trades, I learned something priceless. For every one time jumping the gun would have made a little more, there were 3 or 4 times waiting saved me from a false signal. Consistency beats perfection. The same applies to position sizing, where most traders sabotage themselves. You must decide in advance, based on your account and risk tolerance, how much you're willing to risk on any single trade. And then you stick to it whether you're confident or cautious. Most traders don't realize they change size based on mood. After a loss, they trade smaller because they're scared. After a win, they trade bigger because they feel invincible. That guarantees inconsistent results, because you end up betting big when you're most likely to be reckless, and betting small when you're actually thinking clearly. So I made sizing mechanical. I calculated risk before emotion could influence it. Fixed PE, percentage risk, stops based on market structure, not comfort. That way, I wasn't negotiating with my feelings every time I entered a trade. But even with a solid system, there's another layer to inconsistency. Market conditions change. Trending markets, choppy markets, high volatility, low volatility, bull cycles, bear cycles. A system that thrives in one environment can suffer in another. So how do you stay consistent when the market itself isn't consistent? You don't fight the market's nature. You accept it. You build into your approach the reality that there will be periods where your edge is strong and periods where your edge is weak. The key is not to change your rules every time things get hard. The key is to adjust exposure, not identity. When conditions favor your approach, you trade at full size. When conditions shift, you reduce size or step aside. You don't abandon your method just because you hit a rough patch. Most traders do the opposite. When their approach stops working, they assume the system is broken. They start searching for something new. They bounce from trend following to mean reversion to fundamentals to whatever the latest guru is selling. They're chasing the holy grail, something that works in all conditions. It doesn't exist. What exists is the discipline to recognize when your edge is present and when it's not. I went through a phase trying to have a strategy for every market condition. It sounded logical, until it destroyed me. Why? Because it forced constant second-guessing. Is this a real trend or just a range bounce? Is this chop or a pause before continuation? I kept switching at the worst times, getting chopped in ranges. I tried to trend follow, missing huge moves when I decided the market was range-bound. So I simplified. One core approach, one set of rules, and the discipline to wait for the conditions where it worked best. When those conditions weren't present, I did nothing. I sat on my hands. That drove me insane at first, because it felt like missing out. Everyone else looked like they were making money, and I was doing nothing. But then I realized something. The money I didn't lose during bad conditions was just as valuable as the money I made during good ones. This is where amateurs and professionals separate. The amateur thinks consistency means trading every day, constant activity, always being in the market. The professional understands. Consistency means following the same decision-making process, even when that process tells you not to trade. Sometimes the most profitable decision is inactivity. I remember a period where I didn't make a significant trade for months. People thought I had lost my nerve. I hadn't. I was waiting. Then the market finally aligned with my approach, and when it did, I went in with size. That one trade made more than a year of forcing mediocre opportunities ever could. And that leads to the final piece of the consistency puzzle, the piece nobody wants to talk about. State management, not market state. Your state. Because you can have the best system in the world and still fail if you don't manage your psychological condition like a resource. I learned this during what should have been one of my strongest periods. I was making money, following my system, but I was exhausted, mentally and emotionally depleted from years of pressure. At first I pushed through. That's what ambitious people do, right? Grind, keep going. But slowly, the quality of my execution declined. Not in obvious ways, subtle ways, slower recognition, slightly worse timing, small errors in calculation, less clarity in management. Each mistake alone wasn't fatal, but together they eroded my edge. That's when I learned something that felt counterintuitive. Sometimes you need to trade less, not because opportunities aren't there, but because your mind needs recovery. Mental capital is real. Deplete it and you start making decisions from the wrong place. And the dangerous part is, the wrong state isn't only fear and desperation, it can also be overconfidence and greed. When things are going well, you feel invincible. When things are going poorly, you feel desperate. Neither state is ideal. The best trading happens from calm, focused attention, present with the market, detached from the outcome. That state is difficult because it requires a paradox. You must care enough to be disciplined, and detached enough not to be emotional. So I built routines, I reviewed rules, I reset expectations. I reminded myself that each trade is an experiment, not a verdict on my intelligence. And I learned to step away when my state was wrong. If I was angry, I didn't trade. If I was too excited, I didn't trade. If personal problems were distracting me, I didn't trade. Because there will always be another opportunity. Always. The market has existed for centuries, and it will exist long after we're gone. Missing a day, a week, even a month means nothing. But trading in the wrong state can cost you confidence, capital, and the belief in you. Our system, starting the spiral of inconsistency again. So here's the conclusion, the culmination of decades in this brutal, beautiful business. Consistency in trading isn't about finding the perfect strategy. It's about becoming the kind of person who can perform consistently, regardless of mood, regardless of streaks, regardless of noise. It's about building a system and obeying it, managing risk so no trade can break you, recognizing when your edge is present, having the courage to trade big when it is, and the courage to do nothing when it's not. And it's about managing your psychological state with the same seriousness you manage your positions. Every day in this business is a test of character. The market is always probing for weakness. Your impatience, your need to be right, your fear of missing out, your desire to revenge trade, your arrogance after wins. Not maliciously, just by nature. And the crowd is usually wrong at the extremes. If you're emotionally part of the crowd, you'll be wrong with them. The way you rise above the crowd isn't by being smarter or having better information. It's by being more disciplined, more patient, more consistent. I've made millions and lost millions. I've been called a genius and a fool, sometimes in the same week. Through it all, one truth keeps returning. The trader who stays in the game long enough, who keeps executing through wins and losses, who doesn't let emotion hijack process, that trader eventually succeeds. Not because they're lucky, but because they mastered the hardest opponent they will ever face, themselves. The consistency problem isn't really a market problem. It's a human problem. We're inconsistent. Because we're emotional. Because we confuse activity with progress. Because we can't stand being wrong, and we're addicted to being right. Solving it means solving those human weaknesses, day by day, trade by trade. So here's my challenge to you. Stop hunting for the next secret strategy. Stop chasing the magical indicator. Instead, look in the mirror. Look at your trading journal and find the patterns. When do you trade your best? When do you trade your worst? What emotions create your best decisions? What emotions sabotage you? Build your system around your strengths. Build safeguards around your weaknesses. Then execute it, calmly, consistently, relentlessly, not because it will always work. It won't. Not because you'll never have losing streaks, you will. Because